Just this past week, the S&P 500 has hit another all-time high. Many retirees I speak to, and even some professionals, have been scratching their heads at the massive returns the market has experienced year after year. So on one hand, your portfolio is probably looking pretty good. On the other, you might be thinking this could be a setup for another year 2000. Retirees tend to be very pleased seeing their accounts go up, but it can also cause anxiety to think these dramatic gains could be signs of a significant downturn. In my experience, there are a few critical realities retirees must accept to navigate these complicated markets. So today, I'll be discussing the three critical realities to investing at all-time highs in retirement. You're going to want to stick around for all three because the last one lays the foundation for a successful retirement. But before we jump in, my name is Robert Wakefield. I'm a certified financial planner. And if you're new here to the channel, be sure to subscribe. Retirement planning is such a dynamic landscape, and as important changes appear that affect your retirement, we'll be right here covering them on the channel, helping you to retire like a pro. Let's take a moment to recognize how we arrived where we are today. So, if we go all the way back to 2009, which was the year following the great financial crisis, the returns have been truly astounding. So, it's been 16 years, and 12 of those 16 years have produced double digit returns, with only 2 years producing negative returns. In fact, a $100,000 investment into the S&P 500 at the beginning of 2009 would be worth over $1 million today. That is 10 times your original investment in just 16 years. Now, it goes without saying, we certainly have seen some volatility over this period. But each of these market crashes ended with some of the most extreme bounce backs in history. Let me walk through a couple examples of what I'm referring to here. So first, the infamous COVID crash of early 2020. Everyone remembers this one quite clearly, I'm sure. Hysteria was spreading wild, there was panic everywhere. And over a period of about a month, the S&P 500 fell by over 33%. Now, it's easy to sit back today and say how silly it was for people to sell at the bottom of the COVID crash, which they did. But hindsight is 2020, and a bottom in the market is only obvious well after the fact. In the moment, things were much less clear. Many retirees made the mistake of following their impulses and selling at the worst possible time, costing them hundreds of thousands of dollars. But for those who maintained a disciplined and long-term approach, they experienced one of the most radical market recoveries in history. By the end of the year, the market rebounded 60% from its lows in March. We saw a similar dynamic just recently with President Trump's tariffs, where the S&P 500 saw a decline of over 18%. But here we are just a few months later, and the market is back up 38% and reaching all-time highs. Over the years of working with clients, one thing has become clear. Making dramatic portfolio changes solely due to market volatility is a recipe for permanent loss of capital. When you sell due to market volatility, you don't just have to be right once, you have to be right twice. First, when you sell, but you also have to decide when and how to buy back into the market. Getting just one of those correct is difficult. Getting both of them right is nearly impossible. So here's the truth, and this takes us to our first critical reality. Reality number one, stock prices aren't random. They're informed opinions. Today's stock prices reflect the market's collective view of a company's future prospects. So what does that mean? The market demands a positive expected return for taking on the risk of holding stocks. And fortunately for you, every single day, the market and hundreds of thousands of research analysts around the world are hard at work pricing in that positive expected return for buyers like you. I think we've all probably heard the statement, buy low, sell high. And sure, there's nothing technically wrong with that statement, but I don't actually think it's that helpful. If anything, I think this phrase can actually cause retirees to feel like investing at all-time highs puts you on a definite path to losing money. But stocks are not physical objects, and the saying of what goes up must go down does not always apply. This brings me to reality number two. All-time highs shouldn't scare us. We should actually expect them. If you turn on the news, everyone knows that talking heads peddle all-time highs as if there's some rare phenomena that must be a sign of future pain. But the data tells a very different story. So I found this really interesting study by Dimensional Funds, which I'll link in the description. Dimensional did a study on market performance starting in 1926, going all the way until the year 2020. Over this 94-year period, the S&P 500 reached an all-time high in more than 30% of all months within this time frame. The study also compared investments made at all time highs versus those made after a 20% market decline. You might think it's obvious which does better, but the analysis concluded that the average investment made at all time highs actually had better performance over the following 5 years. So I thought I would share this graph from a 2023 study by Hartford Funds. I'll put the link below in the description, but the report concluded that selling stocks at all time highs and buying back when not at all time highs is a consistent source of massive wealth destruction. This leads me to my third and final critical reality. Reality number three: you can't predict, but you can prepare. While there is reason to be optimistic in the long term, nobody knows the future, including me. And just because someone tells you they do, whether an advisor or someone on Facebook or YouTube, it does not make them correct. So, how should retirees navigate an uncertain future? It's absolutely critical that you build a plan and decision making framework for retirement. More importantly, you need to commit to sticking to that plan when uncertainty rears its ugly head. Trying to predict the future is a fool's game, but predicting the future should not be your goal. Your goal should be to design and stick to a plan that creates the highest odds of retirement success across a very broad range of potential outcomes. Those without a plan often take dramatic action at the worst possible time. In my experience, retirees' reaction to perceived risk is oftentimes more damaging than the perceived risk itself. Having a financial plan, in my experience, is the only way to successfully navigate these uncertain times with confidence. So, just to recap, the three critical realities of investing at all time highs in retirement are: number one, stock prices aren't random, they're informed opinions. Number two, all time highs shouldn't scare us, we should actually expect them. And number three, you can't predict, but you can prepare. If you enjoyed this video, I'd be honored if you consider subscribing to the channel. Also, be sure to check out last week's video where we covered the three big Roth conversion myths. Again, thanks for watching. If you had any questions at all, please leave them in the comments, and I will look forward to seeing you in the next one.